So Nigel, Nick, Bharti, and Ryan, we actually had a prepared intro for you, but I think this was a good lead-in to some of the things that we're going to be discussing with you, which is the institutional adoption of DLT, trends and regulations. If you wouldn't mind, I'm just going to go from the bottom of my screen and have Nigel, Bharti, Ryan, and then Nick introduce themselves so that Reggie can get a perspective, as well as the audience. We're recording this as well, and we just quickly transition into your session. Nigel, could you start?
Yes, good morning. Nigel Dobson, I'm the banking services lead at ANZ, and one of my responsibilities is to drive the digital asset strategy for the bank whilst running the payment systems for the enterprise as well.
ANZ Bank, that was quickly
ANZ,
said. But...
ANZ, for those who are non-Anglo, in Australia.
Okay, perfect. Bharti, you're up.
Yeah, thanks, Karim. So my name is Bharti. I obviously am part of the Zerocap team. So I help manage the private and institutional clients here in Australia and abroad.
Thank you. Ryan?
Yes, I'm also from Zerocap. We're an institutional digital asset manager and technology firm based in Australia that services clients globally. I'm one of the co-founders and the CEO.
Perfect, thank you. And Nick?
Hi, Nick WIley. I'm heading up payments within the Securities and Payments division of the Australian Securities Exchange. So payments associated with security settlement and clearing in the equities and fixed income markets here, with particular interest in fast settlement systems and how we can adopt digital currency in financial market infrastructure.
Well, thank you all. So we do have Reggie for a few minutes. He's got several patents issued and they're contesting the usage of it for a lot of companies that have infringed on that. In the digital space, digital currency space transfer, we obviously, I noticed you guys were here a little bit earlier. If you have a couple of questions for him before we lose him, please feel free, because the conversation is global. What we're seeing in the US is affecting or will affect other global markets unless some other market takes over from us and says, no, we're instituting a better infrastructure, which the Middle East might do before anybody else does, or the MENA region. So do you have some questions for Reggie?
So a quick one from me would just be, who do you think globally is leading the race here at the moment, in terms of institutional adoption? And if you think it is the US, who are the challengers?
Well, the US is not leading the race. The US may win, but currently the opacity, trying to figure out a correct way of saying this, the opacity of regulation in the US and enforcement has hamstrung most of the activity. But because most of the business, the intellectual capital, I believe, is still within the US, and the US is still the largest global market, largest market globally. The US is still in the pole position, but it is at risk of losing it. I am very favorable of how Japan is doing things because, very much unlike the US, Japan has very clear rules that are written down in black and white, and you can read them and you can choose to obey or not. They have the third largest economy, depending on how you count the EU as a bloc or separately. And they have a very, very powerful banking sector. So Japan is definitely in the running. China, second largest economy, in downfall. We don't know where it's going to land, but I doubt if it's going to match the growth of the previous 7 to 10 years. But they definitely have the lead in terms of CBDC implementation, adoption, and research. Again, they have a rather draconian stance on the private sector and their use of crypto, and they've chased almost all of it offshore that I'm aware of. So that's more of a wild card. Outside of the US, China, and Japan, I'm aware of stuff, in MENA. I'm aware of Europe, but I believe that Europe may put regulation. The regulation may be a little tight to prevent rapid growth. But that is pure speculation on my part. I can speak from experience in the US and observation, and I can speak from experience in Japan and observation in China. Did I answer your question? Or were we talking in terms of jurisdiction or actual operating entities?
I guess it could be either, right? And maybe the premise of the question is just, wrong to begin with. Given that we're talking about something that's completely decentralized, is it right to think about it in terms of jurisdictions? Where things are going, maybe it won't be, one country or one jurisdiction to win, right?
Well, it all depends, because nothing is completely decentralized, just like nothing is centralized. This is decentralized, this is centralized. Practically everything exists on a spectrum, between the two. For the US has the largest concentration of both Ethereum nodes and Bitcoin nodes. So from a criminal Department of Justice perspective, I can guarantee you that they will think they have jurisdiction across the world. It is quite possible that argument could be made in intellectual property courts as well. It's definitely made for many US courts. If you touch US dollar, US bank. So if you touch a US dollar or use a US bank, the US feels they have jurisdiction. So, it gets a little convoluted because you have to understand international law, US law, the actual way that crypto works, the way it's implemented. There's a lot that goes into it. It's definitely not cut and dry.
I have one question here from the audience. Reggie, I'll start with you, but if any of you have input into it, we'll go there. And then after this question, we can go into ASX Zerocap. But the question is from Lynn Amoroso. Feel free to decline or answer any part of this question. The question is, can you speak to Ripple and its native XRP use in the future banking system, interconnecting the walled gardens, in quotes, CBDC globally, and also comments on the current SEC case against them and the implications when the case matures and settles?
Well, that's a compound question. I try and shy away from compound questions because it's compound. So one at a time, XRP is a unit of account, it's a token. Honestly, there's really nothing special about it except for the fact that Ripple uses it to raise capital and to use through its ODL systems, on-demand liquidity. But you don't have to use XRP for on-demand liquidity. And on-demand liquidity is just a method of doing business. If you read our patent, right in the general description and specification, you see on-demand liquidity explained in simple English very succinctly. It's just that the patent uses BTC as the bridge currency versus XRP. So you can see that, again, it's not simple. There's a lot that goes into it. Will XRP be used? You don't know. Will Ripple use XRP? We don't know. If XRP is considered a security, it won't work for ODL. And is ODL patented by somebody else? Quite possibly. And that's just on the surface. For the Ripple SEC litigation, SEC v. Ripple litigation, Ripple has done an excellent job defending against that. Another fun fact, the prosecutor that is going after, lead prosecutor going after Ripple actually came after our entity as well. And myself personally, I'm using the same aggressive tactics. If they win on the very specific fair notice defense, that would be very good for Ripple, but it doesn't necessarily decide whether XRP is a security or not. And fair disclaimer, I'm not a lawyer. Okay, I'm just watching from the sidelines as a dad. But it does show, if they win, it does show significant overreach by the SEC. I think it shows that anyway. Another disclaimer, the very DAO, which is the Distributed Autonomous Organization, made up of Veritasium holders, which is a Veritasium token, filed a amicus curiae brief on behalf of Ripple in that particular case. So I'm very objective, but I might not have a totally neutral standpoint.
Thank you so much, Reggie. It was such a pleasure having you today. You've helped us a lot understand and look at what's happening. So I appreciate your time. and your knowledge and your contribution to this event. Thank you so much.
Thank you very much.
Please stay. Please stay. If you have questions for this next group of panelists, that would be great.
Okay, I'll stay in the background. I have a couple of phone calls, but I'll be muted and listening if I can. Okay.
Thank you so much. So we're here, Bharti. Thank you so much for getting us the esteemed panelists here. Institutional adoption of DLT, trends and regulation. We've been at this since very early in the morning, and I know it's very early in the morning for you now, or late at night.
Yeah, you're right. It's about 9:40 in the morning over here in Sydney.
Beautiful. So you're just getting started. You've had your coffee. Everyone else here wants to have a cocktail. I know we did a very, very brief introduction, self-introductions of Nick and Ryan and Nigel. We do have more robust introductions if you would like us to do that. Or Bharti, do you want to kick us off as a moderator for this panel?
I think we're good to kick off, Karim.
Thank you so much. I'm going to go in the background here as well and let you take over, but I'll be watching and listening, and I'll pop up to just keep us on track. Thank you all for being here.
Thanks a lot, and thanks everyone for joining. I think we've had a bit of a good segue into institutional adoption, just sort of given the conversations prior to our panel. But I think, certainly what we're all observing is, a real leadership in the institutional space when it comes to this asset class, and that's for a plethora of reasons. A lot of it has to do with the market volatility, price speculation, which is spooking retail investors. But all the while, we can definitely see institutional adoption sort of moving at God's speed. We have a lot of commentators in the space, and I think it's a timely point for us in this conversation to really address some of the things and some of the misconceptions around cryptocurrency and blockchain technology and financial products. And so, Ryan, I might start with you, if you don't mind, sort of taking us through what the sort of differentiators are between financial products and blockchain technology.
Oh, thanks, Bharti. I think the simplest way to describe it, and I think this is very relevant, just given everything that's happened recently with FTX and all the commentary around it. Blockchain is just the infrastructure upon which the financial products and services are being built. I mean, just as a database or a piece of paper isn't inherently a financial product, it's it's what you do with it, or it's what's stored in it, or it's what's built around it. As far as what is actually considered a financial product, well, regulation is still evolving in the space. And as we just touched on before, this is different in different jurisdictions. Are these assets considered a security, a commodity, a currency, or something else altogether? But I think it's just important to think about blockchain itself and the core tenets being, decentralization, transparency, computational logic, trust and security. And what we're talking about here is a complete paradigm shift in how we think about financial products and financial markets infrastructure. What this enables is disintermediation. I don't think there's going to be complete removal of intermediaries in the space. I think there's still a need for intermediaries in some circumstances, but we're talking about being able to have transactions that do not rely on delivery versus payment, but effectively delivery versus delivery. Like atomic settlement and reduced counterparty risk. Like we can remove the need for clearinghouses, as an example. So, Zerocap, we are, a firm that's actually building in the space, but servicing institutions such as the ANZ Bank, where Nigel is from, and the ASX, where Nick is from. So, I do think it's important, when people read the headlines about what's going on in FTX and the contagion there, that we don't just lump blockchain in with crypto and the people that are actually running the businesses, you know, all these things are distinct.
Yes, thank you very much. And I think that sort of takes us nicely to really drilling into a bit more detail on what some of the top use cases are, you know, for blockchain technology. So we're in a place now where we've got BlackRock, you know, the CEO Larry Fink sort of saying to the market that the next generation of markets is tokenization, and specifically tokenization of securities, which is, you know, an exciting place to be at. And it's, you know, it's definitely something that I think, you know, here in Australia, we echo that. But why don't we sort of go in a very general way and look at some of those use cases, and then I might move the conversation over to Nigel to go into that a bit in detail.
Sure. Yeah, look, I mean, I can tell you what we're seeing from Zerocap's perspective. So we service a range of different institutional clients in 50 odd countries around the world. We're based in Australia. You know, asset ownership, you know, non-fungible tokens is one of the institutional use cases that's really evolving here. I think when most people think of NFTs, they think of Bored Ape Yacht Club and, you know, artworks and the kind of hype that was associated around that's now died off to an extent. But really, we're just talking about, you know, ownership of property. And the reasons why, you know, this is important is that, you know, these NFTs, non-fungible tokens, can improve access and liquidity, allow fractionalization. You know, like I said before, the technology can inherently reduce counterparty risk, allows instant settlement. But so there's sort of property rights, you know, other than art, as I mentioned, music is another one. Collectibles. So, you know, there have been collectibles in gaming for a long time now, and secondary markets that are built around those. But there's a lot of, you know, gaming companies and investment going into NFTs in games, the metaverse as well. So, you know, you know, virtual reality where we can actually verify ownership of assets, be they avatars or, you know, clothes or items or houses or whatever. So really, this is kind of like an extension of Second Life that has been a, you know, very popular VR world for a long time now. And then other sort of consumer products, things like trading basketball cards and that sort of stuff. But as far as institutional adoption, you know, what we're seeing here in Australia and globally, you know, you've got EIB, UBS, the Tel Aviv Stock Exchange now issuing bonds on the blockchain and other debt instruments. You've got funds like major fund managers that we're working with that are looking to tokenize those funds and list them on a venue like such as the ASX. Real estate is another one. So we've got quite a few family offices that are looking to tokenize commercial property in particular. There's already been examples of this happening around the world, and there's businesses being built around this as well, like Bricklet, for example, which specializes in tokenization of real estate. You know, there's plenty of other institutional use cases like logistics and supply chain management. And there's some big names like DHL and Maersk that are investing in the space. Identity and privacy is a really big one. So IBM is investing a lot in the space. You've got Okta, who develops Auth0, which is you know, a very widely adopted identity platform on the internet that's, you know, investing in blockchain. And then there's kind of crypto native solutions as well, like Civic. And I think, you know, that in particular is relevant. And here in Australia, we just saw a hack on our, you know, universal healthcare insurance, Medicare, where a lot of customer identity and records were exposed. So, you know, being able to encrypt that data through the blockchain is something that is really important. There are plenty of firms that are looking at the tokenization of healthcare data, like Chronicle, Whole Care, Patientory, and there's a number of others. There's governance and voting is another use case that's kind of emerging, again, relevant. There's, I guess, growing doubt or loss of confidence in voting systems. So this is something where blockchain can definitely play a role. Legal contracts as well, which is kind of relevant to some of the things that I've already mentioned around property rights, property titles. But I think relevant to Nigel, who's on the call here in particular, like one of the biggest institutional use cases is that just the transfer of money or the transfer of value. And there's a number of firms that are already, playing a very active role in the space. You've got non-banks like Circle issuing USDC stablecoin. There's commercial banks like the ANZ that's issued its $8 stablecoin here in Australia. There's something like over 100 central banks in the world now exploring central bank digital currencies, including the Reserve Bank of Australia, which has a pilot program that's active at the moment. And then there's like infrastructure around payments as well, like, for example, Swift. And again, Nigel was just at the Cybos conference recently, so can probably say some more about that.
Thanks a lot. And I think, Nigel, I mean, there's clearly no doubt that ANZ is doing a lot of innovation and putting a lot of thought in this space. Ryan's mentioned the work that Zerocap have been doing with ANZ in terms of the $8 but maybe we could start with that and then go into a bit more detail on some of the things that ANZ is facilitating in terms of tokenization and sort of better infrastructure outcomes.
Yeah, sure. Thanks, Bharti. Thanks, Ryan, for that segue. I mean, if I might just sort of set up our strategic hypothesis here first, then I'll talk about $8 But it's important that we step back and understand as a bank, what's our approach to the tokenized marketplace. And we formed a digital asset team that took observations from the decentralized venues and amongst other areas that were actively using blockchain and tokens. And when we decided that we determined that there was a significant financial market infrastructure transition underway from the digital protocols of the traditional internet towards the protocols of the token-based economy. And as Ryan's already mentioned, allowing 24/7 real-time settlement, using smart contracts for the all-important facilitation of atomic settlement, reducing counterparty risk, and really importantly, verifying credentials. And one of the areas that we've been very interested in is developing an NFT using an 1155 token to verify the provenance of a carbon credit. So not only tokenizing the carbon credit itself and facilitating the exchange, in fact, soon to be on Zerocap's exchange, but also then locking in the credentials of the project into the token, which I think is a really unique and very interesting development for our customers who want that certainty of origin of projects, for example. Also using enterprise-grade and production networks and services to deliver what we call our capital light transaction services model is really important, right? And that's why we've pointed our attention towards the public blockchains, Ethereum and others, in particular because these are already in production services. We surround ourselves with service providers like Chainalysis, OpenZeppelin for audit, and Fireblocks for custody services and wallet services. And that's, that is as a service kind of a proposition, which for us is capital light and gives us speed to market, which is a really important consideration for a bank. And we'll talk about this later, but I think a lot of banks have started their journey in private permissioned, effectively capital heavy, almost traditional type, in my data center, let's build it from scratch type approaches. Whereas we've said, well, actually there's stuff out there that's in production. And in some ways we feel that the conversation around public blockchains is a little bit akin to the conversations we would have had within banks about 10 years ago about using public cloud. There wasn't the regulatory comfort there. There wasn't the tech risk function prepared to make a big call on certainly a public cloud. And yet the benefits were there. They were evident. And so there was this validation period that we had to go through with public cloud. And now most banks in the world are substantially on cloud and substantially on public cloud. And so we feel we're going through that validation period at the moment. And then when we launched our $8 DC on the Ethereum mainnet back in March of this year, facilitated some transactions with Zerocap for some common customers, and we'll go into a pilot early next year with taking tokenized assets into that venue. This really profiles the rationale for the $8 DC, which is our ANZ issued stablecoin denominated in Australian dollars and backed 100% by Australian dollar deposits sitting in the bank. So it's commercial bank issued stablecoin, but really its rationale is not to make payments better, but rather to progress the thesis that we anticipate significant tokenization in the industry at large, globally, be that traditional assets or increasingly underserved asset markets like carbon and sustainable instruments. And we think that our coin is just a first step in facilitating the simple and natively on-chain transaction settlement for tokenized assets.
Thanks a lot, Nigel. And so there's drawing on this sort of theme of trends that we're observing and kind of building on sort of the overview we've given on tokenization. Nick, I might pass it over to you. It'd be very interesting to hear what the ASX is observing in terms of digital capital markets, and perhaps if we can understand better what you're seeing in terms of the advantages of distributed ledger technology over incumbent technology at the moment.
Sure, Bharti. Look, in terms of what we're seeing at the moment, we're seeing a lot of interest from product issuers, and I mentioned in particular mutual funds in the idea of tokenizing their funds. So we're in discussions with some product issuers. We at the ASX has launched a DLT as a service platform, which we've called Symphony. And so that platform is available to capital markets participants to experiment with the technology and to see what is possible. I think product issuers like mutual funds, I think, see significant possibilities in terms of distribution. And I think also liquidity and cost of operations, as Ryan said, the idea of having a tokenized asset is obviously presents opportunities to distribute those financial products in a way that hasn't been possible to date. In terms of what else we're observing, I think a focal point at the moment, and Ryan also mentioned this, the Reserve Bank of Australia is running a digital Australian dollar research project. So I emphasise it's a research project. The Australian government hasn't decided to issue a digital Australian dollar, but the RBA has been tasked with undertaking research to understand the costs, benefits and risks associated with a digital Australian dollar. The bank has called for expressions of interest. There have been over 160 expressions of interest, which might seem like a small number, but in an economy the size of Australia's, that's quite a high level of industry interest in this concept. ASX, we put in a couple of expressions of interest, and very glad to be working with Ryan's team at Zerocap on those. And I think that research project has prompted many industry market participants to think hard about what that might mean. I think to Nigel's point, a digital currency, it could be a central bank digital currency, or it could be bank issued stable coins or other non-bank issued stable coins, or a combination of all of the above, really foundational infrastructure for tokenized asset markets. So I think it feels to me like that's a good place to start, because the ability to transact value in the blockchain environment is obviously a key enabler of getting those tokenized asset markets going. So we've had interest from market participants, for example, in experimenting with the idea of bond repo settlement using a central bank digital currency is one example. I think in terms of advantages of the DLT over incumbent technology, I'd focus in on two things. There are others that we could go through, but I think data sharing and data immutability are two key ones. And if I could just use two examples that go to institutional adoption that sort of prove out those advantages. At the first, it's not a capital market specific application per se, but the New South Wales state government in Australia has instituted what's known as a building trustworthy indicator. So this was a public policy initiative to basically grade new residential high density dwellings with a trust index, basically, which gathers together data regarding the materials, certification, testing of residential buildings, which is intended to give prospective purchasers a sense of the quality and durability of the residential dwelling they may be buying. And that building trustworthy indicator has been set up by KPMG on behalf of the New South Wales government, and they are using ASX's Symphony DLT as a service platform for this initiative. It's live, it's happening now. So for the first time, prospective purchasers can get an objective rating, if you like, on a property they may be interested in. And importantly, in terms of the economy, insurers, building insurers for the first time are able, based on this data, which is being collected on the blockchain and is immutable and obviously it's the source of truth, insurers can differentiate buildings based on their quality and durability. Now that has real price signals for the market and can positively impact the quality of buildings. So I would call that out as a real world example of how the DLT technology can have real world advantages. And the second example is a superannuation fund administrator in Australia called Grow Inc. For those in Europe and the US and elsewhere, superannuation is what you may refer to as pensions or retirement plans. So Grow Inc. is an outsourced provider of superannuation fund administration services. Again, Grow is using ASX's Symphony DLT as a service platform, basically to reform workflows within the superannuation value chain. So as you would be aware, superannuation fund administration involves a whole range of interested parties, from the superannuation fund manager, the custodian, the insurance provider, and others. So there's real power involved in the sharing of a trusted source of data to reform and streamline workflows, and importantly, to give end investors better transparency of the investments being made on their behalf for their retirement. So if, for example, could give an investor a better insight, if they're in, say, a balanced superannuation fund investment option, well, what is that actually invested in? So the DLT technology can give better insight into the underlying investments that that investor is exposed to. I'll leave it there.
Thanks a lot, Nick. And I think, Nigel and Nick, it's so clear that we, to your point, Ryan, we're really experiencing a paradigm shift, right? It's a new way of thinking. It's a new way of addressing and solving issues. And that requires an element of taking a leap of faith and testing, working with hypotheses and validating some of our thinking around that. So Ryan, I might ask you to elaborate a little bit more on Symphony and Zerocap's role in building a bridge into this world.
Oh, so as Nick was saying, Symphony is the ASX's DLT as a service platform. So for application developers, for registries, for OTC desks and custodians, fund managers, anyone that participates in the capital markets ecosystem can come and build on the ASX's platform, and a lot of that infrastructure is already set up and managed. So you kind of take that overhead out of your process. So Zerocap's been doing quite a lot of development on that platform, working pretty closely with Nick and the team, and we've got a number of institutional clients that are looking to tokenize various assets and list them on the ASX. So they'll be doing that through this Symphony platform. It's a private blockchain, that uses the DAML smart contracting language running on a private VMware blockchain. And what we've done is actually build a bridge from public external blockchains into the ASX's Symphony platform. So whilst it's possible to sort of natively issue tokens on that platform, there are plenty of institutions that, for various reasons, might want to use, say, the Ethereum blockchain, like ANZ did with their $8DC, for example, but they may want to make that asset available within the ASX's ecosystem. Well, they can do that via this bridge, right? So you kind of get the best of both worlds there.
Thanks a lot, Ryan. And I think, what's so clear is, the human thinking is this far in terms of innovation and tokenization, and regulation is here and it's trying to play catch up. And there are so many things to navigate. There are so many nuances between jurisdictions and instruments. So we might sort of address, and Ryan, you brought this up earlier, but let's address what has been the implication, with a series of unfortunate things going on, whether it be FTX, 3 Arrows Capital, Celsius, and what that has meant for the industry today.
Yeah, sure. So, I mean, it's been a busy year, let's say that. Earlier in the year, we saw an algorithmic stablecoin called Terra USD, Terra Luna. Its peg to the US dollar actually broke, which effectively caused a bit of a bank run, and the whole thing collapsed. That had some systemic effects, particularly in the credit markets, in crypto. A lot of other firms that had exposure to that asset, or exposure to other firms that had exposure to that asset, and we sort of had this cascading liquidity effect. There was a Singaporean hedge fund called 3 Arrows Capital, sort of the highest profile prop trading firm that had exposure, and they had a number of loans as well, and defaulted on that loans. And again, that caused this kind of cascading credit effect. So, that's been, I guess it's created additional volatility within the asset class beyond what we've already been experiencing just with this sort of broader macro environment. And then, of course, more recently, we've had FTX as well. One of the largest crypto exchanges by volume. And there are some bad actors, in the space, really. And as I was saying at the outset, I think it's really important to just underscore that the technology is something quite separate from what's happened here. You had a business that really had very, very poor governance, or no governance whatsoever, actually, is probably more accurate. There were intercompany loans, and there's something like $8 billion US that's currently unaccounted for. And, there was a lot of robbing Peter to pay Paul going on, let's say. And basically the whole thing has fallen in a heap. And again, that's meant that there have been a number of firms in the space that have either had exposure to FTX or secondary exposure have really taken a hit. But, as Warren Buffett says, when the tide goes out, you see who's been swimming naked. And there's a lot of firms that were just taking too much risk. And we've seen this in crypto markets before. It tends to operate in dog years, right? Like there's very short boom and bust cycles. And there's a bit of a shakeout with the firms that, really didn't have sound business models. And out the back of it, we get, those firms that are really doing things properly. And I think this is interesting just in the context of the conversation about institutional adoption as well, because we haven't seen any change in institutional strategy or appetite for the technology whatsoever throughout all of this, right? Like in the news, every other week, there's some major institutional player that's getting into the space in some meaningful way. But the way that they're participating is very much at the technology layer. And like there's this offensive and defensive strategy, I think, going on with institutions, where the offensive side of it is, we can use this technology to introduce operational efficiency, instant cross-border settlements, reduce counterparty risk, create new products, reach new markets, improve access and liquidity, and so on. And then there's a defensive aspect to it as well, which is, well, our competitors are doing it, so we better do it too, right? But either way, there's just about every major bank and financial institution in the world is taking a look at DLT in one form or another. So that's really encouraging.
It is encouraging, and I think your observation around the institutional players taking a very sort of panoramic view of this, understanding that their participation at a technology layer is sort of the long game here. And it is ironic that the things you point out about FTX and 3 Arrows Capital. I mean, the market cap for cryptocurrency is so small, yet the press coverage accounts for probably like 90%. At the moment. So sort of sifting beyond that and seeing the longer picture is absolutely key. Nigel, I'd be really interested
to... Something I didn't quite address there as well. You touched on regulation and sort of what the impact of these events is. As I mentioned before, different regulators around the world are at different stages, just as institutions are on their digital asset journey. Like here in Australia, crypto is broadly unregulated at the moment, but there's been various consultation papers from all the regulators and Treasury and whatnot on how they propose to regulate the industry. So this is a very active conversation at the moment. MAS in Singapore is already there. FCA in the UK is already there, and other jurisdictions are still fighting over which regulator actually should be regulating the space. But I think what these events like FTX will do is it certainly bolsters the argument that the industry does need to be regulated. I expect that the capital adequacy requirements just went up about 10x, or at least there needs to be more transparency around a lot of people in the industry are calling for like a proof of reserves of these exchanges because it's so opaque, right? I think we also need proof of liabilities, or you just segregate customers' assets like we do with our custody solution, right? The blockchain already inherently provides us with that transparency and visibility. So let's use the technology for what it was designed for to enable that. But one thing that I hope that we don't see, whilst I'm supportive of regulation for the industry, absolutely, primarily because of consumer protection, I just hope it's not too heavy-handed and swift, because people are just screaming out for regulation in this space now. But I'm not sure that everybody really understands what they're actually calling for. Just that we want regulation. Well, what exactly does that mean? And how is it going to impact everybody's participation in the space? But I think, in Australia, we'll start to see regulations kick in somewhere around mid to late next year as certain, token mapping exercises and other consultations are complete. But, broadly, I think we just look to how other jurisdictions are already regulating the space, and it more or less mimics existing financial services regulation anyway. So I think that's pretty much what we'll end up with.
Yeah, that's perfect. And giving a bit of a global overview and sort of temperature check on where regulators are at in conversation is interesting, because Nigel, if we could maybe drill into some of the conversations the ANZ is having with regulators and sort of really go into that at a deeper level, that would also be very helpful. I think understanding, I guess, where Australia is at, but also how the rest of the globe is viewing, Australian regulation and how that's progressing.
Yeah, sure. I mean, just to pick up on Ryan's comments, most of us will recall, I'm sure all of us, in fact, will recall the global financial crisis brought to the surface a range of systemic linkages that in sophisticated financial products that were, hitherto not well understood or frankly regulated. And so it's not as if we haven't read this book before, in fact, on a much larger scale. So, all of this comes down to governance and regulation and transparency. Fortunately, it was a relatively small systemic bump in the industry in general. But it will shape the conversations that we have with our regulators, and certainly arguably the ones that Ryan will have with the various regulators that surround him. But we also feel that there is a lot of regulatory architecture already in place, which appropriately, and particularly since the financial crisis, has kept most of the regulated financial market in check. Some would argue too much, too heavy, but pendulums do swing back and forth. And so we have a simple byline with our regulators, which, as we describe what we're doing, and particularly with our commercial bank issued stablecoin issued on a public blockchain, we've said, well, if it's same risk, same rules, what is the purpose of the coin? The purpose of the coin is to facilitate payment and settlement of assets. The venue may happen to be a blockchain, but it's a form of financial market infrastructure, and they accept that. And we have been able to give them the transparency, the operational risk framework, and the operational risk assessments that would accompany any bank product approval or any bank system, or even a centralized financial market infrastructure. So, as I say, a lot of that already exists. What the most interesting conversation happens to be is what are we missing? And people scratch their head and go, well, what haven't we covered here? What is, it seems like traditional financial market regulatory architecture globally can cover most of the things we can think of in terms of, how should we regulate, financial crime monitoring, AML, CTF, KYC, all those traditional things. And the one thing that's still outstanding with our conversations with our regulators, and I'm sure this is the same with others globally, as a stablecoin issuer, how many hops of that coin do you need to be accountable as the issuer and the holder of the collateral for behavior that occurs with that coin? At which point I tend to remind our regulators, particularly our central bankers, that they are the issuers globally of the primary means of money laundering on the planet, which is cash. And so if they kind of put that into perspective, what we do have, to Ryan's point, is an audit trail. We've got a range of capabilities with our coin to be able to, even if should a coin fall into a blacklisted wallet, we can burn that coin. So we have a blacklist burn. You can't do that with a 500 euro note, right? And so there are elements of quite a significant beneficial degree of transparency, almost to the point of being overwhelming for us, because we don't know when that obligation stops, right? So that is one of the ongoing conversations. Now, if I send US dollars today from Australia to JP Morgan to a beneficiary, my obligation for AML, CTF, and all of the things that I need to know end with the beneficiary deposit into the JP Morgan account. And what we have with this global system emerging, with our coin potentially in circulation, is where do we draw the line? Where are the sovereign borders, if there are any, in terms of governing that coin? And that's why we fall back on service providers like Chainalysis, and increasingly are looking to, we had a very useful conversation with Swift this week, Swift and then Fireblocks, around how we might use our existing SWIFT public key infrastructure to initiate transactions onto a range of blockchains. And so that's the kind of thinking that's happening within the traditional market infrastructure. And if you think about a 50-year-old company like SWIFT thinking about being an intermediary for its 10,000 plus banks into the world of DeFi via its traditional gateway and PKI infrastructure, that's a really interesting evolution. And I think naming names like SWIFT and those types of financial market infrastructure providers does give our regulators a lot more comfort. I call them anxiety busters, particularly because they understand that, they're familiar with the messaging, they're familiar with the infrastructure and the governance. Yeah, they can identify the governance, they know the people. And that's one of the biggest issues we have in public blockchains is, who do I go for recourse? Who do I go for enforcement of smart contracts? Who do I go to? Who do I call? And that's the tough part. And so I think that some of these networks will evolve into more sophisticated, self-governing, transparent governance blockchains and networks. And one we're very interested in, I'll just say it out loud, is the Hedera network, because of the number of the very few nodes that it has, but they're all run by kind of Fortune 500 names, and that to us is transparent governance, and we understand who's hosting nodes. And so it's almost like this sort of permission to public blockchain. It's got all the benefits of public, speed, transparency, and efficiency, but it's got this sort of governance layer around it. And increasingly as a bank, we're attracted, like some other banks have already joined that network and host nodes, to that type of configuration, because I think that's equally what will bust some anxiety within the regulatory community.
So thank you. We're getting close, though. I have a couple of, I don't want to interrupt too quickly, but we're going to just keep us on track on time. I know we took a little bit of your time early on. I have a question. It would seem, first of all, thank you. It's been very enlightening what ASX is doing and Zerocap and the other partners that you mentioned about securitization of tokens and the blockchain and the advancement of that. It's pretty impressive that you're working towards it. It's really cool to see this. So the question would be, if we had not had the implosion of ATX and companies associated with them, do you think the regulatory environment would have taken longer to react to changes or create changes that work globally? And given that, the second part of the question is, do we believe that there will be a global standard rather than regional economic standards that everyone abides to?
I'll have a stab at this. I mean, I just to the second part of your question, I think what we'll ultimately end up with is like this dual economy or ecosystem where you've got centralized and decentralized. I really believe that's where we're going. And ultimately for the investor or the user, they'll have the choice of which ecosystem they want to interact with. And the question is, if you really boil it down, is who do you trust more, a bank or a smart contract? And there's no right answer to that question. It's up to you as the individual, right? So, on the decentralized side, I do think there will be common standards globally, because we've seen this sort of thing play out before in software, right? Which is basically what we're talking about. But on the centralized side, it's kind of hard to imagine that we're going to reach some kind of global consensus on how this should be regulated anytime soon, because we don't seem to be able to do that with any other sort of financial product, really. Like, every jurisdiction has its own regulators and its own view on how these products should be treated. So yeah, I just don't think that will be any different.
I would agree.
Oh,
sorry. No, you go. I was just going to say, I think I think one glimmer of light there on global regulation, I think, and Nigel could probably speak to this better than I can, was the recognition that stable coins and systemically important global stable coins, as a financial market infrastructure, and an attempt by the global standard setters, CPMI or OSCO, to set some global standards around payment stable coins that attain systemic status. So I do think policy, there is a recognition of the importance of coordination amongst jurisdictions, but I think it's all in the execution. Sorry.
I just add to that. Can I just say quickly, Karim, I think that the events you've described, it may not necessarily allow regulators to move faster, but what I can assure you is that it'll allow them to ask better questions around systemic linkages and governance. And then to your other point around standards, I mean, already, I mean, the TradFi market has already has many standards that use, particularly the SWIFT message types in financial market infrastructure, but also the ERC standards have become prevalent, and they are what we're building on. They've been developed by a bunch of really smart people. They work, they allow interoperability, and so those standards, as you know, banks and non-banks alike adopt them and use them, become the standard. And I think that's a really important message for this group, is that, you know, the standards are there. You know, organizations like us are using them and writing our smart contracts around them. We're getting them audited, and we're confident, to Ryan's point, you know, there's a lot of trust embedded in these contracts, and that they can serve the needs of enterprise grade activities.
Nigel, can I ask you a question? I think I know the answer, but just to kind of clarify a point that you were making there, like, do you think that there will be, you know, one blockchain to rule them all? You know, you mentioned ERC20. Do you think that is going to be the standard?
Oh, I think it'll be a standard for as long as it maintains the, you know, mass adoption, and the standards evolve, right, and they'll become more sophisticated. Will there be one blockchain to rule them all? No, I absolutely do not think there will be. And many actors, including as recent as, you know, as I mentioned, SWIFT and Chainlink, are working on interoperability. And obviously, you need, you know, the interoperability around the standards. So ERC20, you know, EVM compatible, those sorts of things need to be present. But I absolutely think that that interoperability play, which is becoming more and more sophisticated, will serve a range of needs and allow assets and tokens and activities to move across chains where appropriate. And so, no, I don't see a winner take all kind of outcome.
It was similar to your question that we asked before on a panel earlier on, will blockchain rule the world? And the answer was very similar. There will be a consolidation, and there will be some that stand out, and others will just fade away. But yeah, that's a good point. A further question here before we close out. CBDCs, stable coins, do you think that's actually a half measure towards complete distributed ledger technology?
A half measure? Are you saying that a CBDC is not truly decentralized or on a distributed ledger?
Yeah, I think it's still being controlled to a large extent and created for reasons that will not allow for completely distributed ledger.
Yeah, look, you know, it's just still such a nascent space. You know, I know here in Australia, with the research program that's being run at the moment around the Reserve Bank's stablecoin, they're trying to answer this very question. Like, if you read the white paper, one of the things that they say in the very beginning is, you know, we're trying to explore whether there is a genuine need for a central bank to issue a CBDC, or can this be solved by commercial banks like the ANZ issuing their own stablecoin, or non-banks like Circle. So I think it's like really difficult to answer that question until we get it out there and see how people actually use it. Like the way that this pilot here in Australia is being designed. I think Nick mentioned there are 160 use case submissions from various participants in the industry on how they would propose to use CBDC. So a handful of those will get selected, they'll go into pilot, and then we'll see, you know, like, does this actually work, you know, with these coins being issued on a, you know, private blockchain, or does it make more sense for commercial banks to be minting stable coins on the Ethereum blockchain? Like, we just don't know.
Yeah, I think time will tell. I agree with Ryan. You know, we're deeply involved with this pilot EAUD CBDC here in Australia. we'll be a distributor of that coin to a range of those use cases. And we also think that there'll be a case for a risk-free central bank asset as collateral potentially. Do commercial banks have a stake in this? Absolutely. And we think that we can move in different, more creative ways to serve customer needs. We can also traverse public and private blockchains perhaps more easily and follow our customers to where they want to do business. And so I do think that ultimately a CBDC will have a range of use cases, but they will be limited, and they'll be particularly around collateral and risk-free type settlements.
I'm really excited about the whole influence you're having on the tokenization market. That will be very, very interesting to see how that evolves. I mean, it's a fascinating subject. We've been talking about that for a couple of years now. There have been challenges along that path, but I'm hoping that we come to a resolution sooner than later, because that's a really important facet for everything to develop much more rapidly and fruitfully. Before we close out, Bharti, was there any closing words that you had for us?
Yeah, I mean, I think the deeper down the rabbit hole we go, it's very clear that the conversation starts to become quite existential. So, to summarize, I thought it would be a good idea. And initially I said, let's look at this as a 10-year time horizon. But then I thought, let's have a bit more fun with this and look out sort of 20 years from now. So I'd be really interested, just in a sentence or two, Nigel, Ryan, and Nick, to understand, what the world could look like 20 years from now. So perhaps starting with you, Nick, how could the world look in terms of tokenized markets, over that time horizon?
Yeah, Bharti, I mean, we'll look from the point of view of an individual retail investor. In 20 years' time, I'd like to think I would have the ability to invest myself in asset classes that right now are virtually inaccessible to me. So that could be tokenized single asset real estate in Singapore. It could be fine art. It could be carbon credits, precious metals. And I think that's a really empowering future for investors. And I think, as we've discussed today, I think regulation is one of the key enablers of that, to make sure that there's trust and confidence in those tokenized asset markets, but that it's not so stringent that it puts up barriers.
Thanks, Nick. And Nigel, I mean, in terms of the interplay which you've touched on between private and public blockchains, how could that look?
Well, I'm a big believer that the past informs the future, and I'm just going to quickly go back 20 years ago and recount that the number of very large institutional clients that the bank I was working at the time refused to do transactions on the internet because it was unsafe. Literally 20 years ago, and they're very big companies, some of them technology companies. So let's fast forward. I can assure you we won't be talking about blockchain any more than we talk about databases today. And we'll be talking about a range of business models and a range of opportunities, both virtual and otherwise, that banks will participate in, that a huge range of non-banks promoting business models that we couldn't have thought of 20 years ago, just like today in the future. But I'm very, very confident that the infrastructure that's available to us now in its nascent state can take us all the way into that 20-year timeframe.
Thanks, Nigel. And I think, Ryan, maybe if you can answer that question, specifically looking at financial products, structured products and beyond would be really interesting.
Yeah, look, I mean, I'm just the guy that builds the things that people like Nigel and Nick tell me to build, right? So, but what we're seeing in our business is, there's absolutely this growing demand for tokenization of financial products. I mean, you only just have to look at the amount of banks, reserve banks and major financial institutions that are increasingly participating in this space. It just gives you a sense of where things are going. I think, like, we have a thesis that we'll see the tokenization of everything, right? Not just financial products, but also, as I was mentioning before, all kinds of property and assets and identity on the blockchain. Whether or not we get there in 20 years, I mean, 20 years, that's a pretty long time. I would like to think that we'll be most of the way there, but, there are still institutions running legacy systems that are much older than 20 years. So maybe we won't quite get there yet. But I will say that I think it'll be ubiquitous. Most people won't even know that they're interacting with a blockchain. It'll just be the way that we do things.
I would say, Bharti, that we're taking a wager, dinner in Australia or here in San Francisco. Most of the progress will be made in the next 5 years. We won't have to wait 20 years. I don't think so. Thank you all.